All right, good morning, everyone. So I emailed you the company you were going to be valuing and the group you're going to be working with for the last part of the project. So just so you know my steps for assigning companies, basically I just went in alphabetical order, picked one company that I just happened to be thinking of, and then found 3 to 4 of its closest competitors that are publicly listed in the U.S. Dealing with foreign companies just adds an additional layer of work with currency conversion, so just focused on U.S. companies. None of you should have an issue with the company that you're valuing. It being public, it has standards for the history of financial statements that it has to have listed, so you should all have enough information for the company that you're going to be working on. All right, so basically what you're going to be doing here, and this is all laid out under the project section, you're going to be putting together some information to make a decision on basically investing in the company based on the financial statements. All right, so the first part is going to be somewhat simple. All you have to do is download the financial statements for the company, balance sheet, income statement, and cash flow statement, and put that all together in a single workbook. Make sure it's kind of cleaned up and workable. And as you're working on the project, you're going to be building on the information that you're submitting. So you're going to be starting off downloading these financials, and then from there, you're going to be evaluating the financials and continuing on until basically you arrive at a decision on whether this company has been performing well or not. All right, so the first step that's going to be due in a couple of days is just downloading those financials. So let's look at how we go about doing that. And there's many different ways you can download the financial statements. This is just what I personally think is going to be the easiest way. So search Edgar. It's Halloween, so Edgar Allan Poe might be the first result for a lot of you. Going to go to the SEC, Edgar filings. We'll use Walmart as an example. WMT filings. It's a little bit easier to find the workbooks if you just go to the classic version, right? And what you want to find for the annual statements, 10K, looking for 10K, go to interactive data. And from here, view Excel document. Right. And it's going to download a financial report. Definitely recommend saving it with your company's name. And from here, all the statements that you need are going to be gathered. The first page is just going to be some basic information about the company, right? Then you can go over to the consolidated income statement, copy and paste that, open up a new workbook. All right. From here, you can just clean it up, right? So some of the information didn't translate well. Now it's mostly cleaned up and fitting together on one page, right? So now we have our income statement, and you'll just go through and do this for the other financial statements as well. So we have our balance sheets. That's the way I'm automatically highlighting all these. Hold Control and Shift, use the arrow keys to drop down and highlight the rest of the cells. All right, let's make sure we have liabilities through equity. So we have both sides. Alternatively, if you prefer something like assets sitting next to liabilities, you can just copy and paste this over. Yeah, now I'll have assets and liabilities next to one another. You can clean this up a little more with the rows there. And finally, we're looking for our cash flow statement. And there we have it, right? So it's not going to be, the 3 statements that you're going to be dealing with aren't right next to each other, but they're close enough. All you have to do is look at the financial statement to gauge what information you're going to need. And now we have our cash flow statement. All right, important to keep in mind that all the line items that we're looking at in here are not necessarily line items in and of themselves. So for example, when we're looking at the income statement, right, there are going to be breaks that are showing summary information at certain sections, right? So we're starting off with revenue, then we have some expenses coming out that brings us to our operating income, right? So operating income isn't in itself an account that's being reported, it's a summary of previous accounts that are reported. Right, so important to keep that in mind when you're looking at financial statements. Right, you're not always going to be adding or subtracting all items in there. Sometimes there will be bits of condensed information that's a summary of previously reported information. All right, any questions about downloading financial statements? Right, there are other methods that are available. Right, you can get financials from something like the Wall Street Journal, Yahoo Finance. Downloading financial statements this way is going to take a few more steps for you because you're going to have to do some more table cleaning and stuff like that. But you can import, open up a new workbook for this as well. You can import data from a web page. Go to the Data tab from Web, and then just copy and paste the link that you're using to create this table. And you can build up the spreadsheets like this as well. Going to bring you to the transform data page from here. Right, we don't need the 5-year average. Really, you only need the last few years. Having more information though isn't a bad thing. And then from here we can close and load the table, and that brings us to our income statement here through Wall Street Journal. Right, so you have a few different resources and routes you can download this information from. I do recommend using Edgar. It's laid out in relatively simple formatting. You're not going to have to do as much cleaning, transposing, and stuff like that. So I do recommend starting from the Edgar webpage. Any questions? All right. Pretty straightforward. This is going to be the easiest part of your project, just getting the information together. But it's also one of the most important because if you don't download the correct information, then you're going to be messing up all the preceding analysis you're going to be doing. Right, so make sure you get the 10Ks. Right, note we're looking at the. I'll go back to the filing report here. Right, there's a lot of different financial statements that are posted here. You were looking for the 10K. Right, not 8K, 10Q. 10K is going to be the annual report for the company. That's what you're going to be using for your project. All right, so if there aren't any questions, then we'll keep going with the class. All right, so today we're basically just going to be talking some more about financial statements, details on the statements that you're going to be looking at, and talking a little bit about why financial statements are important, what's the motivation for having this sort of information available to us. All right, so who's going to be using financial statements? If you're an equity investor, working for your own portfolio, working for a managing company, a fund, these are going to be one of the go-to sources for evaluating companies on whether or not they're going to be worth investing in. Right, financial statements contain pretty much all the information. Well, I shouldn't say that. Contain much, if not most, of the information you need to analyze them. So you have to go to the company's financial statements in order to value them. There are other metrics that companies might use or that might be valuable to you as an investor to consider in addition to the financial statements, but financial statements are always the starting point for any sort of valuation analysis. Similar with creditors, right? There's a slight difference in what exactly they are concerned with in the cash generating abilities of a company. Basically, creditors, are you generating sufficient cash flow to repay your debt? Equity investors, it's a step further. Are they generating that residual value that's going to be going to those shareholders? Managers in the company themselves are going to be using them, right? They have to know, are the decisions that they're making leading to value addition or destruction in the company? And that's all borne out through financial statements. Right, and from there, if we are making good decisions, how can we continue making them, make better decisions, or how can we reverse course and undo some damages that maybe we've done in the past? Unfortunately, that sort of mindset is not as common. People tend to not like to face the problems they've caused, but that's kind of a whole other issue. But also, managers might look at financial statements of competitors. That's another important thing to understand, right? When you're looking at within industry analysis, right? What are your competitors doing? Do they have an edge in a particular thing? Are they managing their supply chain in a better way that's resulting in a higher cash flow? Is it something that's worth mimicking, right? Or is it something that we can do in a better way? So not only looking at your own company's financial statements to gauge your performance, but getting inspiration from competitors to try to improve, which incidentally is one of the largest motivations for not going public, right? When you are a public company, you're presenting a lot more information about the company that you're working for, right? So do you have a question back there? Okay. When you are a public company, you're providing a lot more information to markets out there, right? So it's also giving you somewhat of a disadvantage because now your competitors, basically like I just mentioned, they can see a lot more information about your company. And lastly, regulators, right? SEC is very concerned on whether or not companies are reporting accurately. That's the nature of that regulatory body. That is what they are tasked with achieving. Are companies accurately reporting information about the company that they are reporting for? All about that. All right, so what are the characteristics that are relevant? Like I mentioned, making decisions is basically what this is all about. We have to be able to make decisions, so there are some necessary conditions for that decision-making process to occur. Broadly, they fall under relevant information and a faithful representation. Those are the two broad categories that fit into how useful for our decision-making is this information. All right, so under the relevance aspect, we have to have some sort of predictive value. Right? When you go to project a company's expected value, you look at a company's financial statements and basically use them to project what their expected cash flows are in the future. Relevant value to any asset is the discounted expected cash flows. So we have to have some sort of predictive information to value any sort of asset. If we're valuing a project, valuing a company, we need to be able to make some estimates about the cash flows those assets are going to be generating. Confirmatory value. So basically, how accurate is this information that we are being provided with, and how much does it track toward the actual value of the assets? And is this useful information? Right, like I mentioned, everything basically comes down to cash flow being generated, and there's a lot of extraneous information in there, but you really do need that information that is going into cash flows to make any sort of decision about an asset. That is absolutely vital. On the representation side, right, we need to have information that tracks with reality. If this information isn't as close to reality as possible, then it's going to be skewing our interpretation and the relevance of it as well. Right, so we need to have full information. Financial statements are laid out in a way that they're trying to contain all relevant information for generating value. Technically, they should be neutrally reported. Right, you don't have you're not trying to report revenues of a certain degree, be it on the positive or negative side. That is one of the biggest issues in financial statements. Is right, managers aren't neutral on their financial reports. They have directional goals in what they're reporting. So that is one of the biggest issues with the representation issue, and that's why there's been a lot of regulation on trying to basically punish people that aren't reporting financial statements neutrally. But right, it's not uncommon to see trials come up about companies misreporting financial statements. So it's not perfect, but it is much better than it was, especially 30, 40 years ago. And lastly, free from material error, right? So that's going a step beyond neutrality with having a bit of sway with actually misreporting information and intentionally trying to mislead anyone that might be looking at financial statements. So definitely the worst thing to observe. It's a step beyond, rational self-interest that you might see in the non-neutrality part. Certainly the most destructive way for financial statements to be reported. Right. And lastly, the bottom row, just things that are good to include as well. Comparability, right? So we started off with very generic understanding of financial statements that we'll continue a little bit more with that today. But there are general structures for all the financial statements that all companies are going to be following. There might be specific line items that are going to change from company to company, and you're likely going to see that within your project by the time you get to phase 2, where you start comparing companies within an industry. You're going to see specific differences in some line items, but the general flow of information is going to be the same. When you look at an income statement, money coming into the company is at the top, then you're going to have all the expenses, then you're going to have the net income. Those specific expenses are going to be a little bit different. Revenues might be a little bit different if you're dealing with typical revenue being produced from a company's operations. Maybe there's also going to be something like a club fee or something like that. Right? That's not necessarily related to the typical production of a company, but it's additional revenue coming into a firm. Right? So there are going to be slight differences, but overall, companies' financial statements are going to be broadly the same across the board. Are they verifiable? Right? Typically, this has to do with auditing, having independent external auditors come in and being able to verify that, yes, this information tracks within the company's internal documents. Timeliness. So is this information relevant now, right? Getting a company's financial statement from 20 years ago doesn't really affect our decisions with it today, right? Companies over 10, 20 years are much different. So we need to have timely reports. That's why we have quarterly reports nowadays. And at the least frequent level, annual reports. And lastly, understandability. So basically, through the structure of financial statements, there is going to be a large degree of understandability when you look at the financial statements themselves, because they have that similar structure across the board. Right, so when we're looking at financial statements, hopefully they are meeting all of these marks, if not at least most of them. The two biggest issues that typically come out is that neutrality and free from material error. So with reporting information, there's mandatory disclosure and voluntary disclosure. So mandatory disclosure stems from simply being a public company. Once you are a public company, you have regulations that require certain standards of reporting and certain information that you have to report. In terms of financial statements for public equities, it's pretty expansive. There's a lot of information that has to be reported to shareholders and regulators. So most information about a company is going to be required of them. A public company. But on top of that, right, managers still want to, in general, convey information to investors. It's necessary not only for them as the firm, but for reaching out to any sort of capital market. Right, a lot of management have stock options, equity in the company, so increasing the value over time increases their pay as well. So there's also a degree of voluntary disclosure that companies will supplement their financial statements with, just to try to provide more material information. Right, so of the required financial statements, we have the big three: the balance sheet, comprehensive income statement, cash flow statement. Those are the most important ones, are the ones that you're going to be focusing on for the project. We also have the statement of changes in owner's equity. Most of that information really is already provided in the other three, so that's more a combination of that information. And finally, explanatory notes, getting into more details about information that we see in the financial statements. All right, so how are financial statements actually going to be put together? So first off, there are the individual elements that we're going to be dealing with: major assets, liabilities, equity, and then revenues and expenses. Right, that basically explains the balance sheet and income statement, and from there we can put together the cash flow statement. Assets, the productive investments that companies are going to be putting their cash into. Liabilities, how they're going to be raising some of that equity. Owner's equity, residual earnings earned over time. Revenues, those are going to be the cash inflows generated from the assets we have in place. And the expenses for generating those revenues, right? Additional costs for basically using the assets that have been invested in. So financial statements are built up from accounts, right? So coffee, that's something I always think about in the morning. Every Starbucks location has point of sale information. They have information about the revenues that they're generating. They also have information about the wages that are being paid to the workers at each individual chain. Right, then the company overall is building up those accounts from each of those individual stores and adding it up to the accumulated revenues and costs for the overall company. Right, so each record for a company overall usually starts in each individual unit. Technology is advancing. That degree of separation is kind of starting to fade out with the ability to track revenues and expenses a little better. Right, so these accounts are becoming less and less idiosyncratic and just more broadly accessible across organizations as a whole. The chart of accounts is basically laying out the specific accounts, and these are what are going to be making up the financial statements, right? So when we say revenue, that's going to be the chart of accounts for revenues for all of the revenues that each individual chain is going to be producing. And then lastly, we have contra accounts. Right, so typically there's going to be offsetting entries. When we're dealing with the balance sheet, there's always going to be offsetting entries where every time we have an increase in assets, we have a corresponding increase in liabilities or equity, shareholder equity. All right, so the information flow for putting together financial statements starts at the individual account. It's built up through the larger chart of accounts and then balanced off with contra accounts in the balance sheet. All right, so when we're looking at the balance sheet, we're dealing with assets. Those are economic resources. It's where money is being parked within a company. Like we had talked about last class, it's listed in decreasing liquidity. So as we go through the balance sheet, each line item is going to be less liquid than the previous one, right? Liquidity, readily convertible to cash. So we're starting off with cash and equivalents, right? Liquid securities, maturity is typically less than 90 days. Why do we call it cash and cash equivalents? Basically, when you start holding on to cash, keeping it in cash itself is value destroying, right? Inflation erodes the value of cash over time. So it's better to, rather than literally hold cash in a bank account, park it in short-term safe securities, something like T-bills, something that have a short maturity, very liquid, that you're getting a little bit of return on, right? You're at least compensating for the inflationary decay for holding on to cash. So cash and equivalents are lumped together, very liquid securities that companies hold on to. Typically, this is going to be used for short-term purchasing, having some cash buffer in case there's any liquidity demands on the company. So it's important to have at least some cash on hand. Same idea for personal financial planning, right? It's usually suggested that you have easy access to about 3 months of necessary costs in some account. So your own financial planning, it's a similar idea with the cash and equivalents for a company. You want to have some cash liquidity on hand in case there's some unexpected expense or some unexpected reduction in revenue that you're able to basically just weather through. Accounts receivable, right? Sales made on credit. You've made a sale, but you haven't collected the cash for that, right? So you're going to be receiving that cash at some point in the future. Inventory. These are going to be products that have been built on the shelves, but not necessarily sold just yet. This is going to be particularly important for retailers, for manufacturers, anything that's going to have a physical product that's being sold. And the last of the shorter term assets, financial assets, marketable securities, right? So technically speaking, right, equities are indefinite assets, but it's readily liquidable, right? So companies, if they're holding on to stock portfolio for retirement accounts, for just another degree of having excess cash, not having any tangible investments in the near future, they can park that additional cash in other financial assets. Right? Also prepaid expenses. So the company is paid expenses ahead of time before they are required of them. Always important to keep in mind assets are a use of cash. Right? So these prepaid expenses reflect a cash outflow of a company because it's basically tying up the company's cash flow. Right? They've prepaid their expense ahead of time. Generally speaking, everything else equal, the further out you postpone your expenses, the better your cash flow is going to be. Same thing for companies, same things for people. So prepaying expenses is a cash reduction of the firm, but sometimes it's kind of inevitable, right? To an extent, the opposite of a accounts receivable. We then have property, plant, and equipment. So these are the larger assets in place that companies are going to be investing in, right? The things that are basically holding inventory to an extent. These are going to be one of the larger asset generators, right? So to sell coffee, you need the physical space to be able to brew, make, and sell that coffee and stuff like that. Right? So property, plant, and equipment is usually going to be one of the larger accounts in a company's balance sheet. Affiliated investments, so right, just having the company as a whole has some equity, say, in another company. Deferred tax assets, so similar to prepaid expenses, but dealing specifically with taxes. And lastly, intangible assets, so patents, trademarks, that sort of thing. These are much more difficult to value. Very often when a company has a patent on something, it's something that they want to hold on to. It's something that they've invested and developed. And so when you don't have a market in something, it's much more difficult to value. So individual patents, they can be much more difficult to value. Goodwill, this is basically just premiums that companies pay for purchasing subsidiaries. Right, so that can accumulate in the intangible asset over time. On the liability side, we have cash coming into a company. Right? Always keep that identity in mind. Liabilities, cash in, assets, cash out, or cash allocated is kind of a better way. Right? So money comes in through liabilities, basically creditors to a company. Accounts payable. Right? So a company has purchased some sort of input to their production, they haven't yet paid for it. Again, keep in mind, cash coming in, this accounts payable frees up a little bit of cash in a company's cash flow. Right? So if we have an increase of accounts payable relative to accounts receivable, we're reducing the net working capital of the company and increasing the company's cash flow. Financial liabilities, short-term debt that the company is going to be taking out, current portions of long-term debt. So just the shorter-term financial liabilities of a firm. And unearned revenue. All right, so this is going to be revenue that will be showing up at some point in the near future on the income statement, but has not yet occurred. Income taxes payable, so taxes accrued, but not yet paid. Again, cash is being freed up. If the company owes taxes but hasn't yet paid them, that's cash that they've held on to and hopefully have used for a productive purpose, has somewhat increased the company's cash flow for this time period. Now we're getting to the longer term side of the balance sheet. So long-term debt, bonds paid over time, deferred tax liabilities. So again, just longer term portions of tax liabilities that the company has accrued over time, often from rebalances on previous financial statements. This brings us to the last part of the balance sheet, owner's equity, right? Residual claim to a company and the accounting identity of balance sheets. Assets equal liabilities plus equity. If we flip that around for equity, assets minus liabilities equal equity, right? Over the long run, if companies are operating well, we should see an increase in the equity of the company. We should see that their retained earnings increase over time from retaining earnings from profitable years. All right, so the equity portion starts off with capital being raised for the company. Keep in mind, this is book value of capital being raised. So typically you'll see the book value of a company's equity is significantly less than the market value of their equity. Additional paid-in capital, so basically raising more money through raising equity. Typically, this is going to be seasoned equity offerings, just added in capital to the company. Lastly, retained earnings and treasury stock. So retained earnings reflecting net income from previous years, net of any dividends being paid out. Again, we should see growing retained earnings for value-generating companies. There's also treasury stock. So this is going to be stock that has been issued or repurchased by the company and held within the firm. Typically, there's a time limit for how long they can hold on to the treasury stock. Very often, it'll be marked for compensation purposes, market purposes, valuation purposes. But treasury stock is stock of the company held by itself. And then any additional changes in income that just result from basically adjustments in currency. Any questions on the balance sheet? All right. So this should cover most, if not everything, you're going to see on your company's balance sheets. Again, one of the most important things to keep an eye on is the company's retained earnings growing over time, right? So some other things to kind of keep an eye on. What does the company's debt look like, right? Has there been an explosion or a crumbling of the company's debt, and what are they doing with that capital? If you see a company increasingly funding itself through debt, that can be a signal that the company's operations aren't sustainable and that it's only being able to sustain itself through raising this external capital. Where is this money being parked within the firm? Are they investing it in productive assets, or are they just holding on to it in cash? Are they using this to grow their inventory, try to increase their sales in the near future? Stuff like that. All right, this brings us to the income statement. Again, the income statements are always going to start with money coming into the company at the top, and then netting out all of the expenses until we get to the bottom line net income of the company. All right, so we have the inflow of companies, inflow of revenue to the company at the top. There's also the gains from asset valuation that aren't necessarily from the sale. So if you're producing something in America and selling to Canada, did we get any value from that change in currency? And then any investment income that the company has from those investments they're holding on their balance sheet. And now we have all the expenses that the companies might be dealing with. So cost of goods sold, right? Whenever you produce something, there's typically a cost associated with it. What is that cost? How much is going to be offset here? Selling, general, and administrative. All right, so this is just general cost of operations, not necessarily tied to the production of any given dollar of revenue, but just general costs that companies are going to be incurring. Some companies report depreciation and amortization by itself. Other companies will lump it in with the previous expenses. All right, so if you don't see depreciation and amortization on the income statement, you will find it on the cash flow statement. But it's not uncommon for companies to explicitly show depreciation and amortization on the income statement. From there we have, oh, actually I've got that in the wrong order. It should be interest expense, then tax expense, right? Taxable income is going to be net of interest. So those are incorrect order. Interest expense, then tax expense. All right, then you have any losses, right? This is similar to you getting potential revenue from there being a change in currency value that's beneficial for you. This is the opposite of that, right? Decrease in value that just happens to be from any decrease in value of the assets. Oh, I forgot to put the bottom line. But after you take out all the expenses, that brings you to the bottom line of the net income. And lastly, we have the cash flow statement. Right? This basically combines the income statement and the balance sheet in a way to reflect the company's cash flows, again, motivated by the manipulatability of the income statement. Right? If profits are relatively manipulable, cash flows are not. Right? These make all the adjustments to a company's financial statements that management have discretion over and reflects actual value being generated or destroyed. That's why cash flow statement is so important. It provides all the information that we need to calculate free cash flow. All right, so at the top of the cash flow statement, we have operating cash flow. Typically, this is going to be reported through the bottom-up method. So it'll be starting with net income, adding back depreciation and amortization. Again, depreciation is not a true expense of the company. It's a pure accounting expense taken out on the company's income statement. Then we net out changes in net working capital. This is money being tied up in current assets or freed up in current liabilities. Right? So that brings us to our operating cash flow. Then we net out our investing cash flow. Right? So money that's being tied up in capital expenditures or money that's being freed up from any assets that we may have sold. Finally, we net out our financing cash flow. So money that we might be raising through capital, or if we're paying off capital, we'll be netting out, and any dividends that are being paid out, netting that out as well. This brings us to our net change in cash. All right, again, when we're looking at the change in cash position of a company, this is a tangible thing. It's making adjustments that we need for time value of money applications. When companies report something on the income statement, it doesn't necessarily mean that they've received cash in hand. And when we receive that cash item, that is the true reflection of the value of that cash. Right? Timing of cash matters. $1 today is not the same as $1 a year from now, $1 2, 3, 5, 10 years from now. Right? So we need to make adjustments. Having free cash flow is one of those first steps we need for making that adjustment. So looking at a company's cash flow statement has vital information for really understanding its value. All right, so I mentioned that sometimes companies will also, well, not sometimes, companies often report non-mandatory information. And this is just some examples of some of the items that companies report, right? So for example, Alphabet will often report clicks for search results and stuff like that. No problem. They'll be reporting the clicks for a particular search. Information like this is especially valuable for young startup companies, right? Prior to any of these companies actually generating substantial revenue, there can be information in their assets being productive just by showing off some examples of how their products or services are actually being used by users, right? What's the interaction rate? So often what you see in these non-financial measurements is basically just evidence of this company being productive, that it's getting its product and service out there, that it's being used and demanded by consumers. And this is information that a lot of investors look for. And there's also additional information that investors will try to use to pair with all this information. So one interesting example is looking at real-time information about parking lot data. Right, so companies may have satellites that track the parking lots of companies just to gauge what is the foot traffic actually going in and out in real time. And they can use that to tie to what's the expected revenue being generated here based on this foot traffic and continuing on from there. All right, so just because companies have financial statement doesn't mean that's all the information that's valuable to that company. There are additional things that companies can use to show value to shareholders, whether it's being generated or destroyed. And additionally, investors may have additional resources at their disposal that they can use to try to bridge with financial statements to impute the company's value. All right, so it's important to keep in mind also there are problems with financial statements as we're looking at them, and it's just important to keep this in the back of your mind as you're looking through them. What we're looking at financial statements are, at the end of the day, estimates. Right? Technology has improved greatly, so this is becoming less of an issue as we're able to aggregate real-time information. But there is still a large degree of estimating going on when you're putting together a financial statement. That's often why you'll see restatements within a couple of years of the financial statement being posted. Right? Companies will update their information. Once they receive that updated information, they'll post a restatement, which is just reposting the financial statement that they had already put out there and updating it with this adjusted information. All right, so within those being estimates, companies have flexibility in what they're reporting, right? Particularly on the income statement, right? So if management's incentives aren't aligned with shareholders, that can often result in financial statements that might lead to, at least on the margin, poor decision making from investors. So very important to keep in mind, right? How accurate is this information? Does it track with historical economic performance of the company? And just try to keep that in mind as you're looking through the financial statements. Is what you're looking at making sense, right? One of the ways that you can gauge whether or not something is making sense is looking at abnormal line items, right? And is there some true economic motive for this change, right? So COVID is a great example for those huge changes you might see in financial statements, right? So if you look at financial statements in 2020, you might see some companies have a huge cut in their revenue that year. You might see other companies with a huge boost in their revenue that year, depending on what the company is and if they're providing something that was in or out of demand during that time period. Right? So try to make sense of any abnormal things you see going on in financial statements. Do they track? Is there an underlying reason for this? And often you'll see in financial statement discussion provided by management of the company why we see this aberration. Right? So read through those, see if it all tracks. And it should, at the end of the day, make economic sense. Right? One of the things that investors like to see is, does this information make sense and can we make decisions from it? And everything should track over time. And if something starts to seem kind of fishy, then maybe it is. Dig into it a little more. If that doesn't result in being able to make sense, then maybe call it a wash and avoid. Always important to keep in mind when you're thinking about financial statements, everything you're looking at is connected. Right? The income statement is connected to the balance sheet through net income, net of any dividends being paid out, right? And assets, when we look at the fundamental equation, assets equals liabilities plus equity, this flows directly to, right, the operations of a company. So assets are going to equal to the starting retained earnings of a company plus the rest of the information in the company's income statement. So add in the revenue, net out the expenses, net out the dividends. That results in your balance of liabilities and equity on the company's income statement. Right? So this information might seem like it's all separated because they're on separate financial statements, but really they are all tied together, and it all comes down to the bottom line: is the company adding or destroying value? So when we have this balance sheet, balanced, we're going to have accounts that are going to be offsetting one another. All right, so on the asset side, we have money being parked in the company, and the liability side, we have money coming into the company, and they need a balance. All right, so what that means is whenever we record something in a balance sheet, it's going to be recorded in at least two accounts, one on the asset side, one on the liability side. All right, so if we have an increase in an asset account, then we're either going to decrease another asset account by the same amount or increase a liability by the same amount, or some combination of the two. All right, so for example, if we purchase a $100,000 asset with cash, property, plant, and equipment is going to be increasing. The offset to that is the $100,000 reduction in cash. Right? Again, keeping things balanced. Liabilities haven't changed. We didn't raise capital to make this purchase. We used our cash, drew down from that to increase our property, plant, and equipment. If we funded it with debt instead, property, plant, and equipment still increasing by $100,000, but now our liabilities are increasing by $100,000. So our balance sheet has grown. We had cash come into the company. It was parked within property, plant, and equipment. Or like I mentioned, some balance. Or if you get this $100,000 purchase, 50% with cash, 50% with equity. Now the balance sheet has only grown $50,000. Our debt increases by $50,000, but our cash is going to be decreasing by $50,000. All right, so when we're looking at the balance sheet, everything, again, balances. If we have cash coming in, that cash is going to be allocated within assets. If assets are growing, there's either a decrease in one of the other assets or an increase in liabilities. All right, so in the US, we use accrual accounting, much to the chagrin of people in the field of finance, because we know that cash flow is important. Accruals are not the same as cash in hand. All right, so this is an important thing to keep in mind, and one of the key differences between looking at cash flow relative to what's recorded on income statements, right? So revenue is recorded when the company expects to receive it, and expenses are recorded as the firms incur them. All right, so very important distinction here between cash in hand and the promise of cash changing. This is the reason why we have adjustments in net working capital. It's the reason why we have adjustments in capital expenditures. Right? We have to make those adjustments to net income to arrive at cash flow, because there is a difference between expectations and actual economic events occurring in cash changing hands. Accrual accounting is going to require these accounting entries as early as possible. Right? So if you make a sale, you made the sale on credit, you have to record it at that time, even though you haven't received the cash in hand. Right? You've made the sale, you haven't received the cash, but you're still going to be recording that in the accounts receivable. So when we're dealing with unearned accrued accounting, there's a couple different types of revenue that we can experience within this. So we have unearned revenue. So we receive our cash before providing any good or service. In terms of cash flow and timing, this is one of the better ways to go about earning that revenue. The earlier you receive your money, the more valuable that money is, everything else equal. And then there's going to be accrued revenue. So this is the exact opposite. So we provide the good or service before receiving the payment. So if you're not dealing with cash changes, everything else equal, unearned revenue is a better way to go about generating your revenues, because you're receiving your cash before you provide the service. And again, timing is important. When a cash flow occurs directly relates to the value of that cash flow. So if you receive your cash before you provide the product or service, that's a cash inflow for you relative to accrued revenue. Similar idea with expenses. But kind of the opposite direction now. All right, so when we're dealing with an expense, the longer we postpone paying that expense, the more cash we have on hand still that we can hopefully use for something productive. So with prepaid expenses, the company pays ahead of time for an expense that they haven't incurred yet. Right? So sometimes this is necessary, right? Sometimes companies require you to pay ahead of time before receiving a product or service, and it's unavoidable. Accrued expenses, on the other hand, is the company owes cash for an expense occurred. Right? So opposite to the revenue now, we want to, generally speaking, prefer accrued expenses because, again, postponing paying cash out of pocket for an expense is going to be increase to our cash flows. So postponing our expenses is going to be relatively beneficial to prepaying our expenses. Although sometimes prepaid expenses do come with a discount, and that discount can be valuable depending on how much it is discounted by. Yes? Yep. So great question. It would start as a prepaid expense, and then it would be counted as cost throughout the course of the year. Yeah, so it balances off. And it's also a really interesting way to start looking at companies' discount rates, right? So I know we're not talking about time value of money much in this class, but right, what an appropriate discount rate is to apply to a cash flow directly relates to the value of that cash flow today. And I think one way to try to get an estimate of basically the minimum discount rate of a company is to look at the annual subscription fee that they'll charge you relative to the monthly one, and see what sort of discount you're getting relative to that. Right? So if you're getting roughly a 10% discount on prepaying that expense, that in a way basically suggests the bottom line range for the company's discount rate might be around that 10%. So there can be some interesting information on those sort of deals that they'll offer you But yeah, as a company, generally prefer to accrue expenses rather than paying ahead of time. One other important thing to keep in mind with the balance sheet is that they're typically recorded at historical costs, meaning when you're dealing with the asset values on a balance sheet, they don't reflect the current values. So if a company purchased property, plant, and equipment 20 years ago, has just been running it at that time, generally speaking, real estate increases over time. Right? So that property, plant, and equipment is recorded in its balance sheet at that historical cost. Until there are any changes with that property, plant, and equipment, they're just holding on to that asset at that value that it was initially recorded in. But there will be adjustments over time, right? And if there are any gains or losses, that's going to be recorded in the income statement. All right, so how does information flow while we're going through these financial statements? We start with our journal entries. So this is the smaller unit in the production chain. You record the transaction, show what changed and by how much. Those are going to be built up into general ledgers. Right, these are going to be sorted across the accounts. So revenues, expenses. This brings you to an initial balance, right? Like I said, a lot of these are going to be estimates. And one of those initial estimates is the trial balance. So what is the starting point for the financial statement that is eventually going to be reported? They double check journal entries and ledgers and bring you to financial statements. So the adjusted balance, right? This is what we're finally going to see in those publicly available financial statements, right? So while companies, if in real time their trial balance looks reasonable and they think it's okay, they can still report it in the financial statement. But if they find out after the fact that their balance was wrong, that's when they go about issuing a restatement. So when we're dealing with financial reporting, there are broad standards that are going to be applied to these financial reports. Bless you. All right, so broadly speaking, the objective is to provide information. Investors, creditors, regulators, they need access to this information. Ultimately, it's going to be for making decisions. Companies within the firm use financial statements. Companies outside of the firm, companies considering being invested in the company in some way. They're all going to be making decisions with this information. All right, so that is the primary objective of financial reporting, decision making. Having reporting standards is basically just a way to try to make sure that this information that we're going to be using is going to be useful. If it's not useful, then what's the point of putting all this time and money into putting these financial reports together? So the usability of these financial statements is often the underlying goal when they're being reported. We need to make decisions. We need information to make those decisions. And again, the future is always uncertain, but we are using these financial statements as the part of our framework to understand decisions we can make to improve that future from decisions we're making today. There are several standard setting bodies. So in the United States, that's going to be the GAAP standards are what's going to be used. They are set by the Financial Accounting Standards Board, FASB. These are about financial statements. Then we have the SEC, which is intended to make sure that companies are complying with the GAAP standards. But then we also have the International Accounting Standards Boards. Also part of the reason I tried to get you all, well, I did get you all domestic companies to value. There are slight differences between FASBA and ISBA, but they're not going to be relevant for the sake of this class. In general, they are pretty similar. There are some significant differences in their accrual standards, but for the case of this class, we're going to be focusing on GAAP standards, using those. All right, so FASB is the governing board. They set the generally accepted accounting principles. The SEC enforces those principles. So what are the filings that companies are required to report? Basically all material information about the company. So Form S1, is the company going to be issuing a security? 10K, the reports that you're going to be dealing with for your project. That's the annual filing. It includes the financial statements, footnotes to them, management discussion and analysis. Quarterly updated financial reports. Those are very similar to the 10K, usually a little bit less information contained in them. Then you have the shareholder proxy votes. So when there's something important that shareholders have to vote on, usually that's going to be dividends, management packages, significant buyout events, repurchases, stuff like that. Material event disclosures, issuing securities, and lastly, security holdings by insiders. And this is something that has received a lot of attention. Insider trading generates a lot of value for insiders. Often it's at the expense of other potential investors that these insiders are trading, right? So there's been an increase in standards held by what insiders can trade by. Unfortunately, in practice, those standards are not really held up too much. Basically, actually, I haven't finished the study yet, but one of the papers that I've worked on basically shows that the average gain from insider trading is much greater than any fines that insiders will get for engaging in those trades. So it's basically in insiders' best interest to engage in as much insider trading as possible because the penalty for doing so is relatively small. So hopefully over time, it's not just going to be filing forms on insider trading activity, but a little bit more regulation on the degree of insider trading allowed. All right. So again, it always comes back to being useful. Financial statements need to provide information. It has to be relevant information. So again, does it tie back into cash flow? Does it have some effect on future cash flows that are going to be generated? And they have to be accurately reported. All right. We need them to be comparable. You need to be able to compare a company to its own performance in the past. You need to be able to compare a company to potential competitors. So you need to be able to understand the financial statements both within a company over time and across companies. Can they be verified by auditors? Right? If they can't, then that's going to be a big issue. Are they being presented timely? And can you read through them?